Hello and welcome. My name's Chris Can with Australia's Mining Monthly and Mining Magazine, and we're in Singapore at the Future of Mining Asia. With me, I have Nick Halkas from SMBC. Welcome, Nick. I wanted to start by asking you about what really is the age-old problem in the mining industry of financing development projects. It feels like it's getting harder. Where do you see the keys to unlocking some of that capital?
Yeah, look, thanks, Chris. It definitely is getting hotter. I agree with you. I think 2015, 16, when we had the downturn in the metals prices, when people started leaving coal, things changed, right? And people started focusing more on renewables and that. So I think the industry has always been a boom and bust industry, but I think that is a big change for the industry, and things became much harder with, I think, a lot of banks. Let's say, lessening their teams in terms of mining. I think you get very few teams at the moment, very few banks that have got mining teams. So if you look at Singapore today, probably SMBC is one of the few banks that has a dedicated mining sector team. The other banks probably have one person that looks at it ad hoc. And I think given that, I mean, the difficulty that we've had over the last decade has just got worse and worse. And I think people have focused so much on the transition and the sustainability. And I think a lot of new entrants that have come in don't really understand that, without metals, there's no green. And so we're aiming for these targets in 2050. You need a huge amount of metals to get there at the end of the day. And what I have found actually is in the last year or so, the focus on EVs has actually been very positive for the metals industry. It's brought back a lot of excitement, especially 2023, end of 2023, a lot of excitement. People starting to talk about nickel, lithium, graphite, all those vanadiums. And what's really interesting is if you just look back 1 or 2 years before the EV, let's say, focus started, if you came to a bank and you talked about vanadium and graphite, it would be very difficult to get that financed because it's not that commoditized. You can't hedge it. From a risk perspective, it's very difficult. However, in the last year, because a lot of your very big companies that are involved in this EV value chain have now turned their attention to these metals, banks are now considering them because you have this, this big promoter behind them. However, things have changed, right? I think by March, April this year, when commodity prices dropped again, people, once again, I do feel it, people have lost that focus. We have a lot of customers that are miners, and they are in that, I wouldn't say early junior stage, but they in that junior stage graduating towards being able to be debt ready, and they just on the cusp, they just a little bit before. So they don't want equity now, that's too expensive. Don't want MES. They're right at the end, and they maybe need a little bit of a push, but this last 6 months, I mean, things have dramatically cooled off. And what we've seen in terms of the vehicle manufacturers really looking at their strategies and that. So I think there's a lot of them where their market caps have dropped significantly. And I think where the market is at the moment, where I see it, obviously sitting on the bank side, I'm able to help these projects when they become debt ready. I don't provide mezzanine, I don't provide equity. And where I'm seeing at the moment is a lot of them have got that equity. And with I think efforts by the Australian government to promote transition metals, they've done a huge amount in terms of providing subsidies. And then after the subsidies, as the projects move along, they actually get funding from government type entities, together with financial institutions like ourselves. And there's a gap now, and that gap actually I think is very important now that we have this mixed financing come to the fore. And I think what's needed in the market now is more of your debt type funds, the ones that are looking for just that high yield. About we're probably sitting in a 4-5% range. Maybe these people are sitting at a more 8-9%, not a mezzanine, right? More the debt funds. I think that would be a huge catalyst for the industry at the moment.
As you say, Nick, the EV story strangely has dried up with a lot of the forecasts and the plans from the autos in particular, and from them the analysts within the banks coming out with their own forecasts for what's required, and it's all pulled back a bit, and that's cooled off. But the story is still a long-term story. Do you think we need to see more agility in the finance sector in bringing in some of that alternative debt style funding than currently exists. Are we realistically in a position where we might see that funding window, that funding gap you're talking about, closing in the next 18 months, 2 years?
Yeah, look, I think the industry is transitioning at the moment. I think that started off with a hype. Everyone wanted to do EVs, everyone wanted to do the EV value chain. And to be honest, I think the big underlying factor for why it's pulled back is just the base fundamental of look at the global economy and look at how high interest rates are. It's just not that easy for people to just go out and buy an electric car, right? Things are difficult. I would have thought if this was at a different time and we had a different global economic condition, I think we would have continued where we started last year. So I think where we are now is maybe a little bit of a breather. People are just reevaluating where they're going to be. I think we need to see where the motor manufacturers decide where they want to be in terms of percentage of EVs versus ICE vehicles. But we're not going back. I think we're going in that direction, and I think it's just a matter of time. And I think a lot of projects were caught within the hype, got dragged along within the hype, and then just got dropped cold. So I'm hoping it's just we need a bit of a breather. Maybe the reduction in interest rates over the next 6 months, I think, will be a big catalyst to get people a little bit more excited again, get some more money in the system. And then after that, I think we'll continue once again. Maybe a little bit of a tweak, maybe not exactly how it was envisioned before, but I think we continue.
Nick, it's everyone's first from Asia. What are your thoughts so far?
Good, really good. I think I like the fact that people have actually started looking a few steps back. Because a lot of times at the conferences, people are just looking forwards, and nobody wants to talk about the really difficult subjects. And I hear a lot of people have actually talked about frameworks, what's required, from the governments to help these miners, what will attract the miner, and these things are important, especially in really tough economic conditions now. I think it's imperative that those frameworks are rock solid, and I think the support of the governments, and you mentioned agility. It can't just be, it can't just be something that it's done in, it's instilled in rock and it can't change. And we're seeing it. We're seeing it definitely from the authorities in the region. I think they're starting to be quite dynamic about it and move around it. And I think there's a lot of people here that really understand the complexities of what's going on. And I think also the IRAs and the new standards being changed in Europe and the new laws coming into place, I think that's where we should be focusing at the moment. We should be focusing on the fundamentals, and miners should be focusing on their costs, because at the end of the day, none of us can control the market.
Nick, thanks very much for your time.
Thanks, Chris.